Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Iron Mountain Incorporated, ticker symbol IRM. We're looking at Iron Mountain today because this is the first time that we're going to be applying the Select 6 analysis to a REIT. A REIT, or a real estate investment trust, is a type of public company that owns, operates, or finances income-producing real estate. They're a special class of business that requires 90% of their after-tax profits to be paid out as dividends, meaning that most REITs end up having very high dividend yields. And most REITs are not subject to corporate tax. Iron Mountain currently is paying out a 4.5% dividend yield. Right now, they're trading for $54.41 per share, and their stock price has increased by 13.5% over the last year. Over their last 5 years, Iron Mountain is compounding at a rate of 6.5% annually. Over 10 years, they're compounding at a rate of about 6% annually. And going back prior to the global financial crisis, over the past nearly 18 years, Iron Mountain has compounded at a rate of 6% annually. Again, keep in mind that their dividend yield would be in addition to this. So Iron Mountain is trading about $4 below their 52-week high. They're up more than $10 from their 52-week low. Currently, 6.5% of their shares outstanding are sold short, and they have about a $16 billion market cap. For additional background about the business, Iron Mountain Inc. is a record management service provider. The firm is organized as a REIT. Most of its revenues come from its storage business, with the rest coming from value-added services. The firm primarily caters to enterprise clients in developed markets. Its business segments include global RIM business, global data center business, and corporate and other businesses. So Iron Mountain has more than 90 million square feet of real estate across more than 1,400 facilities in approximately 50 countries. They store and protect billions of valuable assets, including critical business information, highly sensitive data, and cultural and historical artifacts. Iron Mountain helps customers lower cost and risk, comply with regulations, recover from disaster, and enable a more digital way of working. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Iron Mountain based off of their business fundamentals. So this analysis is still a work in progress. As mentioned, this is the first time we're applying this to a REIT, so this serves as an opportunity to learn in public. I'd love to hear if you have any feedback about the analysis, as the goal is to have this continue to evolve and improve over time. So with that said, let's get right into today's analysis. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. There are 2 major reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured by return on capital. The second is that the average publicly listed business earns about a 7% return on capital, so by asking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So in the case of Iron Mountain, they earn just about average returns on capital that are pretty steady for most of these years. They haven't dipped below 6% return on capital, and they haven't gone above 8%. Over their last 12 months, they're earning about a 7% return on capital, and averaged out, they're coming in right at 7%. So just average for a public business, meaning that even though these are very, very steady, this is going to be an X to start things off on metric number 1. Then next up for metric number 2, here we're taking a high-level overview of the growth of their business. So here, this is a little different from our normal metric. For a REIT, we're going to be looking for 5-year revenue growth, 5-year earnings growth, and 5-year cash from operations growth. We're going to be using that to be a closer model to their funds from operations rather than using their free cash flows. This metric is all or nothing in nature, meaning that all 3 of these are going to have to be up for this to be a check. Or if even one of them is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, Iron Mountain has grown their revenues by more than 30%. Their earnings, while they're fluctuating and they're up more than 3 times from 2017 to currently, have been increasing in these other years as well. And additionally, they've increased their cash from operations by about 19% as well. So all 3 of these are up, meaning that this is going to be our first check coming in on metric number 2. Next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Iron Mountain on a per share basis. So we're looking for earnings per share growth over the last 5 years. Again, in the previous metric, we learned that their earnings are up by more than 3 times over this period. However, earnings are only the numerator in this earnings per share equation, so we still have to look at what they did in terms of their denominator, what happened to their shares outstanding. So over the last 5 years, Iron Mountain has diluted existing shareholders by about 9%. So they've issued 9% additional shares outstanding, which isn't great as a long-term shareholder in a business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that business. And so when a business issues new shares and dilutes existing shareholders, they're decreasing your ownership percentage in the business, which is ultimately going to decrease the percentage of the business's profits that you're entitled to. Shareholder dilution is something that can fly under the radar when you're looking at a business, but it really can be a silent killer for long-term investors, so you do want to be mindful of it. Even still, with this 9% dilution, their earnings are up more than tripled, so overall their earnings per share are up quite strongly over this period, up about 2.5 times. This means that this is another check here on metric number 3. Metric number 4 is going to be changed for our comparison of Iron Mountain as a REIT compared to what we're normally looking at for most businesses. Here we're looking for cash from operations per share growth over the last 5 years. This is not a standard GAAP metric, so we're going to have to do some calculations here. In 2017, Iron Mountain produced about $2.70 of cash from operations per share, and even though this declined into 2021, over their last 12 months, they're actually producing about $2.94 worth of cash from operations per share. Over the last 5 years, their cash from operations per share is actually up. So yet again, this is another check on metric number 4. To recap where we stand currently, through our first 4 metrics, Iron Mountain has 3 checks and only 1 X. Next up for metric number 5, we're evaluating how they're utilizing leverage. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are at the greatest risk of poor outcomes. REITs, by their nature as tangible real estate assets for the most part, are going to tend to have higher levels of debt financing than most other businesses. Even so, we want to make sure that their leverage position is reasonable to the cash coming into the business. We want their net debt, which is their total debt minus their cash and short-term investments, to be below the amount of cash from operations that the business has produced over the last 5 years. So we're using cash from operations again, specifically for REITs. Typically, we'd be using free cash flow here. So at the end of 2021, Iron Mountain had about $11.5 billion worth of net debt. Currently, they have about $12.8 billion worth of net debt, and over the last 5 years, they've only produced $4.4 billion of cash from operations, meaning that Iron Mountain looks like it is very highly levered relative to the cash coming into the business. There are potential reasons why this higher debt load could be potentially deceiving here for Iron Mountain. However, if you're interested in learning more about their debt loads or you have possible concerns, you can dig into the company's filings and learn about those in more depth. So this high debt load means that this is going to be an X on metric number 5. Through our first 5 metrics, we have 3 checks and 2 X's. Then the big metric of them all, metric number 6, we want their average cash from operations to their total enterprise value to give us a yield that's above 5%. If this is the case, this would potentially give us a slight risk premium compared to the rate of the 10-year treasury yield, and potentially give us another reason to be interested in Iron Mountain. We're using their total enterprise value because it takes into account both their market cap and their net debt position, and gives us a picture of the economic reality of the business that's going to be more similar to as if Iron Mountain were a private company. So right now, Iron Mountain has about a $29 billion total enterprise value, and we learned that over the last 5 years, they produced about $4.4 billion of cash from operations, meaning that in an average year, they're producing about $880 million of cash from operations. So when we divide their $880 million of their average cash from operations by their $29 billion total enterprise value, that gives us about a 3% average cash from operations to EV yield currently. So that's both below that 5% benchmark we're looking for, and it's below the rate of the 10-year treasury yield, meaning that on an average basis, this is an X here for metric number 6. Over their last 12 months, Iron Mountain has produced about $860 million of cash from operations, meaning that their current cash from operations to enterprise value yield is very similar to where it is on an average historical basis. So both on a current and an average basis, it doesn't look like Iron Mountain is giving us the risk premium we'd ideally be seeking at today's valuations. Yes. Then as a bonus, we're looking at Iron Mountain's dividend profile. So again, as a REIT, Iron Mountain has to pay out 90% of their after-tax earnings as dividends. So they have a very high dividend yield of 4.55% currently, which is about 3 times better than that of the yield of an S&P 500 ETF. However, it's important not to blindly chase dividends as people make mistakes all the time by doing so. Instead, you want to stop and look at the underlying fundamentals of a business to determine whether or not that company's dividends are well supported by their abilities to produce cash flows or earnings depending on the type of business, and to evaluate the fundamentals of the business overall. We learned that despite their very high dividend yield, it looks like Iron Mountain is very highly levered, and in all 5 of these years, they did not bring in enough earnings to be able to support this dividend, and they've actually grown it throughout this time. Even though their earnings are closer to what they've been paying out as dividends in recent years, they're still not fully supporting their dividends. So it looks like Iron Mountain could be in a potentially precarious position when it comes to its long-term stabilities in terms of being able to pay out these dividends going forward. and at the same time maintain a more reasonable amount of leverage in the business. So again, if this is a potential concern for you, you'd want to dig in and learn more about the company to get a deeper perspective here. Which takes us on to the key points of the qualitative aspect of the business. Starting with some of the key points around a potential long thesis for the company. Number one, the integration of Recall and Iron Mountain, the transformation initiative, and the farther maturing of certain emerging markets should drive additional revenue and margin expansion over the medium term for the business. Number two, the firm boasts an attractive dividend yield relative to other REITs. And number three, Iron Mountain operates a highly durable business model with consistent cash flows, and new opportunities in areas like data centers provide a more attractive growth runway. Then for some of the key points around a potential short thesis for the business. Number one, Iron Mountain's reported earnings fail to cover its dividend, and its highly levered business model leaves it susceptible to tripping debt covenants. Number two, the firm's first forays into the data center business is unproven, and the firm's growth estimates may prove to be too optimistic. And then number three, technology and declining demand for Iron Mountain's core storage business will cripple the size of Iron Mountain's available market and will remove any advantage it may derive from switching costs. So hopefully that offers a balanced perspective around some of the qualitative aspects of both a long and a short thesis for the business, and betters your understanding of the business in addition to looking at their financials. So in summary, Iron Mountain checks the box on 3 out of 6 of our metrics. They're earning just average returns on capital. However, they have managed to grow their business over the last 5 years on a per share basis, even with 9% shareholder dilution over this time. Then it looks like Iron Mountain, even as a REIT, is using quite a bit of leverage in their business, especially compared to their cash from operations. And then both on an average and a current basis, it does not look like the business is giving us that adequate risk premium we'd ideally be looking for, as their cash from operations to enterprise value yields were below the rate of the 10-year treasury yield currently. Then looking at their dividend profile, it does not look like Iron Mountain has been sustainably able to pay out their dividends based off of the cash that they're bringing into the business. So that's a potential concern if you're interested in the business, in part because of its dividend yield. This type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. Instead, this analysis serves as a beginning and holistic understanding of Iron Mountain to help you determine whether or not it's worth your time and energy to dig in and learn more about the business. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel, as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, you're ultimately trying to conduct your research as if you're going to own 100% of a business, and you can truly understand the underlying essence of the business and know what's important and what's not important for that company going forward. So through your deeper research, you'll learn more about the qualitative and the quantitative aspects of Iron Mountain, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Iron Mountain Incorporated, ticker symbol IRM. So as mentioned, this is the first time we've applied the Select 6 analysis to a REIT, so I would love to get feedback on the analysis. So if you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next, REIT or otherwise. Thanks for learning about Iron Mountain with me, and have a great day.